Right. Welcome to Financial Accounting. This is chapter one. This is going to be the first of two lectures. I'm going to have these posted. So, this is a walkthrough. I'll be walking through the slides with you to explaining everything out, trying to give you real world situations and examples as we go through, as if you were lecturing in the classroom. Now, I'm also putting this is the first time I'm ever putting adding what we call a podcast. And so I'm going to have AI turn this into a podcast. So if you're unable to watch this and go through it with me, then you can go ahead and click on the podcast, and that should be audio, and that should help you out. And I believe what I'm going to have is two people talking. So hopefully this will give you, either way you want to digest it, this gives you something to understand this chapter. So in chapter one, in this lecture, we're going to be talking about explain why sections 1.1. We're going to explain why accounting is important and list the users of accounting information. We're going to go into 1.2, describe the organizations and rules that govern accounting. Then in 1.3 and beyond is going to be in the second part of the lecture. That's going to go when we get into nuts and bolts and start actually doing some equations. We're going to describe the accounting equation, define assets, liabilities, and equity. We're going to use the accounting equation to analyze transactions. Looking at transactions, showing you how to prepare transactions and prepare financial statements, how to enter transactions and prepare financial statements. We're going to use financial statements, return on assets, or ROA, to evaluate business performances. This is what we're going to look at in the last 1.3 through 1.6 will be in the second lecture, and I will also cover those again when we get to that section. So let's talk about 1.1. Why is accounting important, and list the users of accounting information? We're going to talk about why accounting is important because it is important. I know with the things changing randomly, accounting's not going anywhere. Now, who's doing it and who's doing what section may be changing, but companies are always going to need some kind of accounting method. This is the best way to explain to people, and we're going to talk about it. Accounting is the information system, measures business activities. What are we talking about business activities? Any purchases, any revenue, any kind of income that the company takes in, any kind of business that the company does, whether that's buying or selling or providing services or any of that, that all comes down to accounting, and measuring of those activities is what accounting does. Okay. It processes the information in reports. Not only does it account for this, we're talking about measuring business activities. That's when we're talking about transactions. But when we start talking about turning that into something that's reportable, something that is feasible for somebody to understand, then we're talking about reports, right? So we're going to break down all these transactions that we do, and we're going to put them into a report that anybody who has an understanding of accounting can understand and can relate to the business and see where the business stands and take on different aspects of the business by doing that. We're going to communicate the results to decision makers through these reports, right? So whether you're going to be an accountant, you're going to be a manager, you're going to be something that has to process what the business is doing, you're going to need to understand accounting in one form or the other. You don't have to be an accountant, but you do need to understand what these reports are telling us. So we're going to go through this. So what do people visualize, right? When we look at visualizing model, we often think, and even me as an accountant, I kind of focus on this section where we go into all these different data rules, right? And so this is the way you do it. This is how you do something. Yes, let me go before we go in too far. There are certain things, and this is how you do it, right? You can't. Personal judgment does not come into debits or credits. Okay, we know we're going to have to talk about when we talk about credit and debit transactions. There's a certain way to do it, and you have to do it a certain way. But that's not the overall of accounting. Real accounting, when you get into past the reports and being able to process information, is not always black and white. It goes, and then we see right and wrong, yes or no, assets, liability, and then we turn out financial statements. Some of this, yes. But the truth is, we go in and we start with good decisions, right? And then we go the opposite, right? So we have economic activity and then shades of gray, and then we go into accounting judgments, which takes critical thinking, especially if you're in the tax. I've worked for some firms that are pretty lenient on the way they read the rules and how they implement certain deductions. And I've had another firm that said, if it doesn't say it, we don't do it. Okay. And we do not want to talk to the IRS. And if the IRS does come and wants to talk to us or file a report and say, no, that's not how you should do things, we have all the backing and and all the different accounting methods and examples to show that yes, we can do it this way, right? And then we take that useful information, make good decisions, and prosper society, right? So by doing things and being able to analyze what our transactions are, making good decisions, we are being able to make these business prosper better. And here's my attempt. Let me see if I can of animating this so you can kind of see how everything goes. We have all these, right? But it really comes to this, right? This is where we're really focusing on good decision making, economic activity, shades of gray, right? You have to have critical thinking and you have to analyze things and be able to put in your own judgments, right? Now, this is not say you can make your own judgments out of thin air. No, you're going to rely on other examples and different regulations to help guide your path. But this is also going to help you decide which decision to make. So, decision making, users of accounting information, financial versus managerial accounting. What is the difference? Right now, you're taking a financial course, right? So, financial accounting, we make reports and we do transactions for external decision makers. Well, who's that? Should I invest in a business? Investors. Is the business profitable? Not only investors, maybe banks, people that want to loan money to the business. Should I lend money to the business? Can the business pay us back? These are people like investors, like I said, investors, people that are thinking about investing in the company, people that are thinking about lending money to the company, the owners of the company to understand where they're at. That's in there as well, external decision makers. But what we really do, regulators, all that is external decision makers. Now, managerial accounting is mostly for internal decision makers. We're talking about managers, we're talking about the board, we're talking about which they're also going to take into account financial accounting, but managerial accounting, most of the things that we do into managerial accounting is solely based on people that are already in the company. How much money should the business budget for production, right? That's going to tell that we're going to learn that through managerial accounting. Should the business expand to a new location, right? We're going to create reports and look at transactions. They'll help us make that decision with managerial. And how do actual costs compare to budgeted costs? And this is a lot of things that we do in managerial. The process, we'll talk about cost accounting and things like that as you go through. If those of you who want to be accountants or get an accounting degree, you'll look at these different subjects and see how they affect the internal organization. Now, financial accounting provides information for external decision makers, such as outside investors who own portions of the business. Yes. Creditors or lenders whom the business owes money to. This is important. They need to know what's going on within the company. Financial accounting tells us this. Taxing authorities, the government whom the business owes taxes, right? So there's a lot of reasons why we do a lot of things. When we're going to talk about GAAP and things like that, why we do accrual accounting, but then also sometimes we have to look at when you take a tax course, you're going to look, some things are going to be through cash. And that is the reason we do that is if we haven't received money, we can't pay taxes on it. So this is where we get taxing authorities as well, right? So they want to know what's going on with the company as well. Managerial accounting provides such information to decision makers such as managers, employees, individuals within the company, and then businesses, right? The business themselves. How are we doing? How are we doing compared to others? Financial also tells us this, but managerial does this in specific ways to help out. Now, what kind of accountants are there? Certified public accountants, CPAs serve in general public, right? They usually serve in firms, right? But CPAs can also serve for private corporations as well, right? And they can serve for private companies as well. Chartered global management accountants have advanced knowledge in finance, operations, strategy, and management. CGMAs, right? And then CMA is the two big ones that you'll learn in the industry is CPA and CMA. And they specialize in accounting, financial management knowledge, and often work for a single company. So CMAs are more of the industry type, but you do see CPAs in the industry as well. CPAs often work in CPA firms, right? I've worked in both industries. I've worked in the CPA firms. I've worked in corporations, right? And it's a totally different world. But you will see CMAs a lot in the corporate world and CPAs in the corporate world and in public accounting, in the public firms. Certified financial planners. Now, these help individuals budget, plan retirement, save for education, and manage their finance. I'm still going back through this, but from my understanding, CFPs, they can get the reason that this is up there is that if you become a CPA or CMA, usually certified financial planners have to get a finance degree and then work for a financial firm and test. and then that's how they earned their CFP. There's a way you can test for the CFP without having to work for a financial firm, and that way is to become a CPA or a CMA, and they get to go past that and not have to work for a financial firm like Edward Jones or Merrill Lynch or something like that, right? Schwab. You don't have to be a broker to become a CFP if you already have a CPA or a CMA. Different financial positions, right? Accounting positions. Of course, the CFO is Chief Financial Officer. This is in comparison with the CEO, right? They're an executive officer of a company. As a primary responsibility, the company's finances include financial planning, record keeping, and financial reporting. Usually make at least six figures, right? If you become CFO, you're making quite a bit of money. Controllers are in the same bracket. They compile financial statements, interact with auditors, and oversee regulatory reporting. Usually, controllers are overseeing a corporation's full accounting department. A controller usually reports to the CFO. The CFO will be ahead of the controller, and they may take on more than just the accounting department, but they are usually in an accounting position. Business system analysis, use accounting knowledge to create computer systems, and you can see their pay range, right? Depending on which business you're working at and your grade, how far you experienced you are within the company. Tax accountants, usually in CPA firms. Companies do have tax accountants as well, help companies navigate tax laws. 45 to 174, I would say that's low. When I went into the industry, I won't say, it was quite a while back, but most guys were starting around 50 instead of 45. And that was in Amarillo, Texas. So I will say that's low to 45. Auditors perform reviews of companies to ensure companies. Those you usually see in CPA firms as well. I would say that pays a little low as well. Cost accountants typically work in manufacturing business, help analyze accounting data, 55 to 115. That's pretty good. Accounting clerks, bookkeepers, I would say maybe a little bit higher than 31. Record financial transactions and help prepare financial records. This is where we're going to talk. I'll go ahead and mention it. We're starting to look at AI and maybe the reason for accounting clerks, because I know bookkeepers make more money than that. But the reason for that downgrading is mostly due to AI. When you see technology starting to take over industries, it usually starts at the bottom up, right? So usually those who have a greater understanding will still need to be around to make sure that AI is still doing the correct job and to understand the information that AI is producing. So usually bookkeepers are one of the first to go and then move on from there. Data analytics and accounting. Accountants need to understand how technology is used to process financial information. Most accountants, and I'll tell you this, I've worked in 2 different firms, 4 different companies, and every one of them had a different type of accounting program. So you'll need to just to understand different analytics within accounting. Accounting and finance individuals actively work with information technology teams to develop accounting systems, right? So everywhere I've worked, even at the college, I was a senior accountant at the college. I had at least 6 different passwords because I had to work 6 different programs to get everything out that I needed to do. And especially if you start working with government, right? The college is a government entity, and so the government has their own programs. So you'll have to learn that as well. Artificial intelligence, cloud-based systems, and robotic process automation are all changing the way companies handle financial information. Some of the companies that we talked to the last accounting meetings are starting to take on AI and use it for their accounting. But here's the thing: most of these companies are going to be huge companies. You can't put or private information. It's not wise to put private information into a system that is not a closed system. So most of these companies we see now that are starting to use AI are starting to purchase their own. They're a big enough corporation or company where they can purchase their own servers or get their own data separated from the whole AI analog system. So you're not sharing private information, or that's not getting thrown into the system where anybody who asks can get that information out. Learning objectives, right? Describe organizations and rules that govern accounting. So this is going to be our second part, and this will be the end of this lecture. We're going to talk about this section, and then 1.3 will go into the next section. So what are the organization rules that govern accounting? So accounting is governed by different bodies depending on where you're at. Now, the first thing is when we're talking about who's looking at what kind of regulations and how to do certain transactions, the FASB is always Financial Accounting Standards Board, is the private organization that oversees creation and governance of accounting standards. They monitor GAAP. But They are not the final authority. They are given their authority through the Securities and Exchange Commission, right? Is the government agency that oversees U.S. financial markets, right? SEC is over everything, but the FASB is the one when we're talking about who's going to talk about regulations, different standards, how we do different transactions. That's always going to be the FASB. Now, depending on that's what we're talking about GAAP. FASB is usually done through GAAP, right? So accounting guidelines are called generally accepted accounting principles, GAAP. So GAAP is what we're usually doing. Now, we're doing this for bigger companies. We're doing GAAP for corporations. If you're a small mom and pop shop, you may not do GAAP. You may do cash basis, or you may do something hybrid type of GAAP. But for the most part, any large corporation, any large company, any company that has to report to, show financials for loans and things like that, most of them are going to be done through GAAP. So I will say this depend on let's just say that all of them were going to be through GAAP, right? So this way we know what we're going to use. Useful accounting information must be relevant, right? It has to be relevant to what you're doing, allows users to make decisions. If you're trying to make a decision on whether to open up or whether to invest in a firm, I need to show you something that is related to that firm, right? You don't want their subsidiary, you want what that firm is doing if you're putting your money into them. Have faithful representation by being complete, right? We don't want to be missing out on certain days or certain accounts. Neutral, right? You can't be opinionated, and free from error, right? So we try to do our best, free from error. You will learn that, especially when you're starting out, you will have errors, right? And even in being in there 10, 15 years, there's still times I have errors. I am not perfect. I like to say I have dyslexia because I have very hard time reading and understanding numbers. So you would think that I would not be a good accountant, but somehow I've pulled it off, right? I was able to understand it all and do it, but I have to always watch myself because I transpose a lot of numbers. I end up putting in numbers sometimes and have to rethink it. So I've always been pretty fast. So I pay attention to detail myself by doing things twice. I always just say, hey, I'm going to go through this. I know my pace, and then I'm going to go through and double check everything. And so then I'll find my error. And you'll see as we go through this course, there are different ways to check for errors. Okay, so now what if we're talking about a corporation that's somebody who sells to companies all over the world, which is just about every major corporation we have now? Who signs off on the accounting standards and who stands and different reports that are held overseas? That's going to be the International Financial Reporting Standards. IFRS are a set of global accounting guidelines, and those are like your FASB for international standards, right? Used or required by more than 166 nations / jurisdictions, including the United States. If you're going to be doing international, we still go by GAAP, right? So if you're a company who does, say you do business, like Coca-Cola does business in China, they do business in the United States, they're going to have a separate set of books for China. There's going to be IFRS. They're going to have a separate set of books that's in the United States, that's GAAP. It's published by the International Accounting Standards Board. So the IASB is going to be IFRS is going to be your standard, which is going to be like your GAAP. And then the IASB is going to be the board that issues those standards, which is going to be like the FASB. An organization that stands apart as a separate economic unit follows the economic entity assumption. An economic entity can be a sole proprietorship, a partnership, a corporation, limited liability company, right? So these are different entities that stands apart from separate economic units. So a lot of now we're not talking about liability here, right? Because sole proprietorship doesn't have limited liability. They do have the owner and the company are one entity, but they are separate from other entities, right? So we're talking about when we do, these are the different that we can do books on, as they are standalone or they are business in themselves. So when you do business, you fall under one of these 4 different categories, either sole proprietorship, partnership, corporation, or an LLC. So let's talk about the differences in these, right? So definition, sole proprietorship, a business with a single owner. Partnership, a business with 2 or more owners and not organized as a corporation. Now, we'll talk about you can have different partnerships, right? But you have to have at least, when we're talking about numbers, you have to have at least two. Corporations can have one or more owners, which are called stockholders. And this is a business organized under state law that is a separate legal entity. Now, you can have private and public corporations, right? So let's say Walmart, public corporation. HEB, one of the largest private corporations in the whole United States. They're still a corporation and they're still owned by stockholders. Okay. Limited liability company, a company in which each member is only liable for his or her own actions. This can have one or more. And usually, if you take a business principles class, we talk about this. And this is one of the things that we always suggest if you're going to own a business is to have limited liability. And the best way to do that is to form and structure an LLC, which is not very hard. It's like $350. I've done the paperwork at least 4 or 5 times. And it definitely protects you from having your property, your assets being under scrutiny through that corporation or through that company. Life and organization, a sole proprietorship, it terminates owner's choice or a death, right? Because the owner and the business are one entity. Partnerships terminate at the partner's choice or death, right? So they're depending on the partnerships can last quite a while, right? Corporations, one thing people love about corporations is they're indefinite. Easy to transfer ownership. You just transfer over stocks, right? Sam Walton started Walmart, started the corporation, been long gone. Walmart's still thriving and will still keep on thriving after his children and probably after his great grandchildren have passed on. That will still be an entity. Limited liability companies, same thing. You can organize it just like a corporation with stockholders or through different ways of passing on the company. And what we usually have is, I'm trying to think what the name of, I don't think they're governors. I think they're called, forget, they're not called stockholders. You can have it as stock, but usually members, I can't remember the paperwork, but I think is like governors, I believe is what the members are called. Personal liability of owners for a business debt. The owner is personally liable for everything that happens in a sole proprietorship. You got to be careful. It's very easy to be a business owner here in the United States. You can open up a lemonade stand and you're a business owner. But if you don't go and either form a partnership, a corporation, or an LLC, you and that lemonade stand are the same. So you're going to be personally liable for anything that happens at the lemonade stand. Partnerships, partners are personally liable. I won't get into too much detail, but you can have ways to have limited liability within a partnership. Stockholders are not personally liable for a corporation. That's one of the things why people like corporations. You are only liable for what you put into the company. So if I bought a stock from Apple and Apple went bankrupt tomorrow and they still owed millions of dollars, they're not going to come knocking on my door saying, hey, you're a business owner, you owe us part of this money. No, I can only lose what I paid for that stock. And then limited liability companies, members are not personally liable. You're not personally liable with an LLC, though you have to make sure that you are separated from that company. So you have to have separate set of books, you have to have a separate bank account, all these things to distinguish the company and distinguish you and make sure that you're not the same entity. Taxation, sole proprietorships. This is one of the things that they're very easy. They're not separate taxable entities, so it's very easy to do their tax returns. The owner pays tax on a proprietor's earnings, and it's a small business. Partnerships is not taxed. Instead, partners pay tax on their share. So what you're doing is a separate Schedule C within your own 1040, which is a pretty easy way to do the taxes. Professional organizations, physicians, attorneys, and accountants usually do partnerships. Corporation, separate taxable entity, corporation pays tax. This is where we get into double taxation. Usually a business or a corporation will pay tax, and then if they pay any of their stockholders, those stockholders will pay tax. So this is where we talk about double taxation. A corporation from small business to large multinational businesses, and then limited liability companies, they're not taxed instead members pay tax on their share of earnings. But you can choose to be taxed as a corporation if you set up the LLC like a corporation. You can have that. But most people will not go down that route because that route is quite difficult and it costs quite a bit. Usually you have to have an accounting firm do that for you, while you could have TurboTax do your taxes for an LLC. An alternative to the partnership, right? So that's and a sole proprietorship is our LLC. Okay, features of a corporation. separate legal entity. It's its own. Walmart is its own thing, right? Apple, they're their own thing, right? They're their own entity. It's not one person. We may think of one person when we think of that company or that corporation, but they are not the corporation. Corporation is a standalone. It has a continuous life and transferability of ownership, very easy, right? All you have to do is pass on your shares to someone else. No mutual agency, limited liability of stockholders. You only owe owners of the corporation, you only owe what you pay in. Separation of ownership and management, right? So I do get to vote on some things, but I don't tell the CEO just because I own 50 shares of Apple. I don't tell, is it Cook? I don't tell, is it Tim Cook what to do? No, I don't do that. I just look and see where my shares are at, right? And if I agree or disagree with them is dependent on whether I sell or keep their stock. Corporate taxation, so the entity itself gets taxed, and then government regulation is very strong in when it comes to corporations. Organization of a corporation creation begins when organizers called incorporators obtain a charter for the state. Many charters are developed in Delaware just because of their loose laws and the least restrictions than any other state. The charter includes authorization for a certain number of shares of stock, which represent ownership in the corporation. This is how you fund your company through ownership of stocks by selling stocks. Incorporators also agree on the bylaws that guide the organization. Once created, stockholders control the corporation through an elected board of directors. So, the one way you do influence management in a corporation is delegating who is going to be on the board. And the board then chooses the executives. And so that's how you decide, that's how you have an influence. So, structure, we have our stockholders who then vote to see who's going to be on the board of directors. And those board of directors have a chairperson of the board, which appoints a president or a CEO. And then you have your vice presidents or your fellow executives, right? So, a lot of times we look at this president spot as a CEO, and then we see like a CFO, a CIO, a technology officer, and I can't remember what their name is. But you have these different, and in this example, we're showing vice presidents and corporate secretary. So, in addition to economic entity principles, the following principles are part of GAAP. The cost principle. So, what is the cost principle? The cost principle states that acquired assets and services should be recorded at their actual cost. There's a couple of reasons we do this. The reason for the cost principle is we want to know, one, we want to know what we paid for things. That way, if we end up selling them or we end up losing them or they end up going bad, we know how much to write off in cost, right? If, say, I bought a machine and all of a sudden, we'll talk about this later. Most things that we buy that are big machines or something, we depreciate over time. And if this machine ends up going down before its time, I need to know how much is left on that machine, how much I paid for it, and how much of a loss I can go ahead and claim. Now, also, we need to know if we have to sell that machine or we end up selling it, if we have a loss or a gain on that. That goes into taxes, right? So if I bought a machine or I bought something and I paid $20 for it and I sold it for 10,000, I have to claim that income as a company. The going concern assumption assumes that the entity will remain in operation for the foreseeable future, right? Going concern is, are we going to keep on going, right? So the assumption, we're always assuming that the company is going to survive. And this is where we get into net income and net losses, right? If you start getting too many net losses, going concern is, are we going to be around next quarter or next month? The monetary unit assumption requires that all the items of financial statements be measured in a term of monetary units, whether that be dollars, pesos, euros, whatever entity that you're working in and whatever area you're working in, we use monetary units, right? So we have a way to monitor what things cost and have a way to measure it within the monetary system of what country we're working in or what country we're doing business. Everybody uses a monetary system. So we're going to say that everything is going to be, we're not going to put it in gold. We're not, even if we did that, but we usually do it in what the currency amount is in that country. So ethics in accounting and business and audit is an examination of a company's financial statements and records. Many companies and corporations, due to credit liabilities and things like that, have to audit themselves. And what does that do? An audit is where people come in, usually accountants, auditors, usually CPAs. They come in and they review all the transactions, they review all the reports, and how people are processing those transactions. And then they give an audit and saying, are these people doing things correctly? Can they improve? And this is where you get into things that are these reliable, free from error? That comes in through the audit. Because we've had some things in the past, say like Enron and different scandals like that, which involved accounting, we started that got was SOX, right? Saberins-Oxley Act requires companies to review internal controls. This is one of the big things about the Saberins-Oxley Act is that now CEOs have to sign off on all financial reports. So they can no longer say, I didn't know what was going on. I'm not aware. I left my CFO to do that. No, all CEOs have to be knowledgeable in that area and have to know where their company stands and what's going on within their financials. The Public Company Accounting Oversight Board, the PCAOB, this is another different monitoring board. It monitors the work of independent accountants who audit public companies, right? So you have FASB who monitors GAAP, but then the PCAOB also does another layer of monitoring over audits. Okay, so that's learning about the accounting system and describing what's going on within the accounting system and why we need accounting and why we use it. And we're going to start the next lecture with a learning objective 1.3. We're going to describe the accounting equation to find assets, liabilities, and equity. All right, so we'll see you in the next lecture. Okay, this is the second section of chapter 1 lecture. In this one, we're going to go more into uh, the meat and potatoes of accounting. We're going to start talking about different things like assets, the accounting equation, assets, liabilities, and equity, how transactions are performed, why we do transactions, and what happens when you do transactions. What's the format, and how does it work? So let's go ahead and start talking. First thing we're going to talk about is describe the accounting equation to find assets, liabilities, and equity. So the accounting equation. What is the accounting equation? So the accounting equation is the basic tool of accounting, measuring the resources of the business and the claims to those resources. So the way I like to say it, so there's assets, that's everything that composes of the company, okay? So all the things that are composed of the company, we're going to go into each one of these. We're going to talk about. But here's the thing. When we look at assets and we look at everything that composes of the company and things like cash, things like equipment, things like supplies and so forth and so on. The thing that we're going to look at when we look at this accounting equation is regularly when you look at a business, everything is either owned by the company, right? By an owner or by somebody. If it's a corporation, it's owned by the corporation, it's bought out, or it's owed, right? Either they got it on credit or somebody else is proposing that for the company, providing that to the company on a credit basis. So then they're being paid for that, but it's either owned or owed, right? And liabilities, those are things that are owed, right? Anything that we have on credit, anything that that we're still paying on that belongs to somebody else, but they're allowing us to use it as we pay them over time. That is a liability. Equity is things that we own, right? If we took out a loan and we have cash in our business, that is owed. That is something that we owe, but you can see it as an asset. You can see it inside the company. But if it's just something that we first started the company with, right? We started the company and we had $50,000 in cash that we put into the company. That is owned. That is nothing that we owe anybody else. That is equity, right? This is what the company owns. So an asset is an economic resource that is expected to benefit the business in the future. Anything that you can provide now that will help us create more revenue, more income, right? Cash, we use cash to keep the business going day to day. We buy new things. We use cash to expand, to grow. These are all things that are going to help us in the future. Merchandise, inventory, these are things that we're going to sell to generate revenue. Furniture, right? Furniture helps us work to generate revenue and to make more revenue in the future. Land, this helps us to provide a space to create our product, to provide a service, right? So all these things, assets are things that are going to help you provide revenue in the future, help you make more money as you go along. That is what an asset is. An asset is something that's going to help out your company in the future and going to help you generate revenue, right? You may not think of furniture as something that helps you generate, but right now I'm sitting on a chair making this video my chair is helping me provide, you know, this class, which is helping me generate revenue, generate a paycheck. If I was making videos for a podcast or something like that, furniture, the chair I sit on, the mic I speak into, right? That is helping me generate revenue for the future. So these would be assets. Liabilities are debts that are owed to creditors. Many liabilities have the word payable in their titles, right? So examples are accounts payable. Accounts payable are things that we have on account, usually some kind of supply, some kind of merchandise that we have, uh, our materials that we have acquired, but we are paying them over account. And accounts payable is something that's less than a year. Notes payable, these are usually loans or long term leases, long-term things like mortgages that you pay over a year and or long-term liabilities. Salaries payable, that is something, so what happens is salaries payable, we generate salary expense, right? We generate a salary expense by having employees that work for us, and over a time period we owe that employee, right? Usually you work a few days or you work a week, say you get paid monthly. Well, if you work a week, that is a salary payable, right? After a week, you can generate a salary payable. We'll look into that more deeply and more in detail when we actually start looking at transactions in the future. Equity. Owners' claims to the assets of the business are called equity, or also called stockholders' equity. So when we look at corporations, we're looking at businesses. Stockholders' equity is what can be claimed by the stockholders, right? Which has two components: contributed capital, right? So contributed capital is also called paid-in capital. Contributed capital is the amount invested in the corporation by its owners and stockholders. Common stock represents the basic ownership of every corporation. So contributed capital is what we paid. So when we look at stocks and we're selling stocks, the contributed capital is when we have initial public offering, an IPO. So when stocks are first being sold, when they generate that first income, that is contributed capital. That is what stockholders paid to grab those stocks. Now, when you sell them on, we'll talk about this later as we talk about stocks and things like that. When you sell them on the market, right? Most of us buy stocks, we buy them secondhand. So that's not contributed capital. When companies first sell stock, that is contributed capital. And that is the money they put in, right? That's the only money they can be liable for. Retained earnings is equity earned from profitable operation that is not distributed to shareholders. So, retained earnings are the net income that we decide to keep as a company. So, if a company goes out there, makes a profit, they have two choices, and we'll talk about this in a second. They can distribute some of this income and earnings that they've made, and can turn them back and give them to their stockholders, right, in the form of a payment called a dividend. If they decide not to do that and they decide to keep all the money, put it back into the company and help with operations, help either grow the company or help pay down debts or whatever they need to do, or just hold on to it, that is called retained earnings. And that is also stockholders' equity. Stockholders have a right to those funds. If they, decide that they're going to, if the company's ever dismantled and things are sold, stockholders are entitled to that equity, right? Now, here's the thing: equity is always behind creditors. So creditors always get first in line. We'll talk about this later. This is increases result of contributed capital. So there's two ways we can increase equity: is we can have either sell more stocks and have more money come into the company, or we can generate revenues and keep our net profits, right? We can go out there, make a profit and keep those profits, or we can have people buy into our company and buy more shares. Decreases in equity result from dividends. This is when we get our net income, we generate our revenues, generate our profits, and then after we have our net income, we can either send it back to that dividend is giving it back, piece of that back to the sharing it with the stockholders, or expenses, right? So things that we purchase, and that's anything from daily expenses to liabilities that we may hold. But those are the two ways we can decrease. Now, we have equity. So accounting equation is expanded to show the components of equity. Okay, so equity is going to break down further. So we have our accounting equation, which is assets equals liabilities plus equity. The great thing about this equation is that you can always, let me jump back to the basic form of this: assets equals liabilities plus equity. the best thing about this is that if you know 2 out of the 3, you know all 3, right? So if I know assets and I know liabilities, I know what equity is. If I know equity and liabilities, I know what assets are. But now we're going to break it down into a more detailed path. Equity actually turns into contributed capital plus retained earnings. So retained earnings is going to be dividends, right? So common stock is contributed capital, and we take away dividends. We add revenues. That's revenues are not profit. Revenues is income we generate that we receive for services or items that we sell, right? So the income we receive, that's revenue. Now, to get net profit or gross profit, and we're just going to break down this further. We're going to look at revenues minus expenses, right? So that shows us a form of profit. Net income, right, is revenues. Uh, Revenues are greater than expenses, right? So if we generate more income, say I made this month, say I made a podcast and I generated $1,000 on the podcast, and my expenses for the podcast were only $110. I have generated net income. Now, if revenues are less than expenses, then I have net loss. Say I, only made $50 on the podcast, but it still cost me $110 to run it, or it cost me over $100 to run it. Then I have a net loss. Okay, so companies that have net income, will keep on flourishing, and will at least be able to stay alive and keep on producing. Companies that have net losses over time, if they cannot turn it around, eventually will have to close. Now, let's look at objective 1.4. This is using the equation to analyze transactions. So the equation just shows us where things are located within the business. Now we need to know how we use them to make transactions. The first thing we're going to look at is what is a transaction, right? A transaction is an event that affects the financial position of the business and can be measured with faithful representation. Step one, identify the account and account type. So, what's a transaction? Anything that affects the business. If you bought something, you sold something, you received income, you performed a task, you paid an employee, all these things are transactions, right? So, when we look at the company and we see what they're doing, we need to go first thing is identify the accounts and account type. In this transaction, we are buying a computer for the office for $2,000 cash, right? Now, hiring a new employee, that does not equal a transaction, right? And we looked at this. Why is not hiring a new employee a transaction? Because it doesn't shift the income or the assets of the company. Now, paying a new employee for their first paycheck, that constitutes a transaction because that affects your income, that affects your cash flows, that affects your business as far as assets are described. If that employee goes and does something that earns revenue, that's a transaction. Okay, so buying a computer for the office for $2,000 cash, maybe that is a result of hiring a new employee, but the hiring of the new employee is not a transaction. Buying that computer for the employee is the transaction. So the first thing we're going to do is identify the accounts and the account type. We're buying a computer for the office at $2,000 cash. So we see one asset on there. There's $2,000 of cash, and then computer is the other asset, right? So we have two assets here. We decide if each account increases or decreases, right? So if I'm buying a computer, right, I'm adding an asset that's going to increase. And if I'm buying it for $2,000 cash, my cash is going to decrease. Now, overall assets don't change. I'm just changing the form of my assets or what they consist of. And step three is determine if the accounting equation is in balance. Accounting is like a scale. Whatever I do to one side, I need to do to the other, right? Or if I affect one side, I need to affect it in two different ways. And we'll talk about this. In this transaction of the accounting, when we look at the accounting equation, we're not doing both sides of the accounting equation. We're only staying in the asset side, right? But we're not changing how much they consist of. We're only changing what they consist of. In the end, we still have $2,000 of we still have that $2,000 of assets. We just exchanged it from being cashed to now being equipment, computer equipment. Now, let's look at what happens here. So, we're going to go through these transactions and we're going to see how they affect the accounting equation. So, in transaction number one, stockholder contribution, Sharina Bright contributes $30,000 cash to Smart Touch Learning, a corporation exchange for stock. The effect of this transaction on the accounting equation is, so what happens when we look at this? Well, assets change, right? Now, assets have gone up by $30,000. Now, the corporation, the company, the corporation now has $30,000 cash. Equity, right? Common stock now goes up. Now we have $30,000 common stock that, and we'll, if you take financial, start learning about par and things like that. But we'll say that each, we'll just say that we're not going to say how many shares of common stock. We're just going to say that she has $30,000 in common stock. The corporation does. So the corporation, two things happen. We got $30,000 in assets, cash, so that went up. And in common stock, $30,000 of equity went up. So now our assets equals our equity. If we look at the equation, $30,000 equals $30,000. Transaction two, purchase of land for cash. Smart Touch Learning purchases land for an office location, paying cash of $20,000. Now, this is where I'm going to tell you, okay, so we had assets, right? But we don't have any liability or equity being affected in this transaction. That doesn't mean that it's wrong. You can still have transactions, and a lot of transactions will only occur on the asset side, but you still have to have assets equals equity. In this transaction, we see that cash has gone down by $20,000. It leaves us $10,000 cash. Land has gone up by $20,000, but gives us $20,000 land. Our assets still equal $30,000. Equity has not been, affected, and it's still $30,000. If we take this equation, we see that 30,000 equals 30,000. Assets equals equity. Now, learning buys office supplies. So Smart Touch Learning buys office supplies on account, agreeing to pay $500 within 30 days. Now, when we look at something that says we're going to pay it on account, that means that we have not paid it right now. So what we've done is pretty much made a credit card purchase. We've made a purchase on credit. And so what does that do? Well, first thing is it gives us something that we bought. So assets go up. We have $500 worth of office supplies. This is something, an asset that we had, and it's gone up by $500. We also see that liabilities have gone up. When I buy something with a credit card, right, I get that item, right? I purchase that item. But guess what else goes up? My debt. That is liabilities. Liabilities have also gone up. So we have an accounts payable of $500 and we have office supply of $500. At the end of the day, we still look and have $30,500 on assets, $30,500 in liabilities and equity, right? So we have $500 of liability and $30,000 of equity. Both sides still equal. They have to always equal. You always have to have. I like to think of it like if you're a science major, which I was not good at science. I'll go ahead and admit to that. One of the things you hear is, for every action, there is a reaction, right? So this is same thing with, accounting. It's like a scale. When you affect one side, you have to affect the other. Or, if you affect one side, you have to make sure that it evens out to where it was before so the other side doesn't tip over. The scales have to be even. So if there's any reaction, there's got to be a reaction somewhere. There has to be a second part. Now, we'll also learn that it doesn't always have to be two. There can be three accounts affected by this. Okay. So Smart Touch transaction number four, earning of service revenue for cash. So this has actually made some revenue. What is revenue? Revenue is any time we have completed a task where we are owned money, right? It does it mean when we file for revenue, when we generate revenue, uh when we go and cut somebody's yard or we sell them a product, it doesn't mean that we've received payment yet. A lot of places may receive payment later, but it doesn't mean that we have cash in hand. What it does mean is that we have done what we have said we're going to do, and we're going to receive payment for that in the future. And so, anytime that, because what this is called an accrual basis. Anytime we've done something to earn payment or sold something to earn that payment, we go ahead and write it down as revenue. So, revenue does not equal cash. Okay. So let's look. First thing that happens is we get we generate revenue. In this situation, we did generate revenue and then receive cash. So this time we did get paid, but not every time, right? We don't always have to be paid for revenue. We're going to look at that in a little bit. So what happened? We went and we provided a service. We did some training for the clients. They came out and they paid us $5,500 in cash right after we did the job or as we did the job. So what's affected there? $5,500 in cash. Our cash went up to 15,500. And then revenue, service revenue is a new account that we see on the equity side, and service revenue went up by 5,500. So now we look at both accounts and they even out. Look at the next question or the next transaction. Transaction number 5. Earning of service revenue on account. Smart Touch Learning Platforms, a service for clients who do not pay immediately. Here you go. All right. So they didn't pay us immediately. The client promises to pay $3,000 within 1 month. So what we've done is we generated an account receivable for them. What we're saying in accounts receivable, if you look on the asset side, we see a new account called accounts receivable. That is money that is owed to us. So I don't know how old you guys are, but I remember Dumb and Dumber, and I remember when Jim Carrey and the other character, they went off on the spending spree with all this money they found in the briefcase, and they wrote IOUs for everything. This is an IOU to the company, right? Now, just because we didn't get paid, we still are owed that money. So we go ahead and put that IOU in there, right? That they're going to owe us. So we have an accounts receivable, and that accounts receivable is $3,000. That is a promise that the other company is going to pay us, or whoever the client is. They promise to pay us within 30 days. In this scenario, they're going to pay us within 30 days. So what happens? We generate revenue of $3,000. We haven't received cash, but we have generated revenue of $3,000. So we go ahead and put in our retained earnings, our service revenue is $3,000. And our accounts receivable, now a new account under assets, is $3,000 because that IOU is worth $3,000 for us. So it's going to take the place of cash until cash can come in or the client starts paying us for this. Transaction 6, payment of expenses with cash. So here we're actually going to pay something. Smart Touch Learning pays $3,200 in cash expenses, $2,000 for office rent, and $1,200 for employee salaries. So the first thing they're going to do is what happens? Our asset, if we look at the asset side, our assets are going to go down. We've paid out cash. Cash is going to go down by $3,200. So that gives us a new balance of $12,300. Now, there has to be something else that comes with this, right? That it has to equal. If we're not changing the type of assets we have, in this scenario, we're paying expenses. Now we need to look at the retained earnings, which is going to be our revenue minus expenses, right? So now we have two new accounts, rent expense, that's going to decrease our service revenue, and salary expense is also going to decrease our. When we take those and we put them into it as negative numbers, now our assets equals our liabilities plus our equity. Transaction number 7, payment on account. So now that IOU that we have, right? We have an IOU to another company. We start paying on that IOU. So Smart Touch Learning pays $300 to the store from which it purchased office supplies in transaction 3. So now we're starting to pay down our IOU. We're starting to pay down our debt. This is the payment on our credit card bill, right? And so we made a $300 credit card payment, which lowers our cash, right? Now our cash goes from $12,300 to $12,000, but it also lowers our debt, right? So I have to make that credit card payment. Yeah, it sucks that money's coming out of my account, but also it's better that I don't owe as much. And so now the accounts payable goes down, which lowers our liabilities. Yes, our assets go down with cash going down for that payment, but also our liabilities go down. And transaction number 8, we're going to collection on account, accounts receivable. So this is where we start collecting from the company that we did a service for, and now they're starting to pay us their IOU to us. So Smart Touch Learning now collects $2,000 from the client from transaction 5. So if we go back to transaction 5, we let them go ahead and give us an IOU for $3,000, and on this day they gave us $2,000 of those $3,000. So in this scenario, we're not going to mess with anything on liabilities or equity. Once we've already written down and accounted for that revenue, we don't generate revenue again. We've already generated revenue. What we're doing is we're changing up what our assets consist of. So our cash is going up by 12,000 or by 2,000, but our accounts receivable is now going down by 2,000. So now we have less accounts receivable and more cash. So we're not changing how much of assets we have. We're changing what those assets are accumulated of, what they are consist of. And so now we have less accounts receivable, less IOUs that we have in our account, and more actual cash in our account. So it's actually looking good for us. Transaction number 9, payment of cash dividends. So Smart Touch Learning distributed a $5,000 cash dividend to the stockholder, showing up right. So she decided she was going to make a corporation and she's going to make a distribution to herself, right, of dividends. So in this account and this transaction, two things are going down, right? So cash is going down, $14,000 minus 5,000. So we're pulling $5,000 cash out of the company, gives us a new balance of 9,000, right? But then also dividends are going up, but dividends are actually a negative number. So when we put in that negative 5,000, we're putting in negative 5,000 because that is taken away from our common stock, right? We're taking away how much we have in common stock, which is lowering our capital. We're paying that out in dividends. So when we do, you'll see this later when we roll over the books, we'll see that common stock minus dividends is what's going to leave us with new capital. And so, uh, our new equity. So we have dividends go up by 5,000, but they're actually going to go bring down common stock. They're going to be a negative number. So here's the list of the transactions we've already completed. This was the owner starting the company, or making her first contribution to start the corporation, and then this are all our purchases in different accounts that we made. And then we can see you're going to have a problem, a homework problem. And I believe I've done it on a video and walk you through where we keep on carrying the balances and we put in every transaction. And so we look at all the transactions that we've created and accounted for and making sure that assets equals liabilities plus equity, right? Now, let's look at the fifth section, and this is going to be financial statements. So after we create all these transactions and account for them, we go and we take these transactions and we prepare and put them into what's called financial statements. These statements are to help you break down and see the outcomes of everything that has happened within a certain time period to a certain day. So I'm going to explain that a little bit better when we talk about the different financial statements that we cover. So the first thing we're going to do when we look at these financial statements, I want y'all to see which financial statements we're going to cover. We're going to cover the first one is income statement. What does an income statement do? It provides information about profitability for a particular period for the company. So when it says particular period, when we look at an income statement, we're usually looking at an income statement for a certain period of time, either a month, a quarter, or a year. This way, why do we do that? So we can compare them. We can see how things change from month to month. We can see how things change from quarter to quarter. And we can also see how things change from year to year. And we can talk, this year was a good year. Why did that happen? We can break that down and see the income statements telling us what did we make, right? And so you're looking at revenues, everything that we've taken in as far as generating revenues or generating income, and then minusing expenses with everything that we paid out. And so then the income statement that's the statement that's going to tell us, did we make a profit? Did we make net income? Or did we lose? Did we make a loss or net loss? Okay. Statement of retained earnings informs users about how much of the earnings were kept and reinvested in the company, right? Statement of retained earnings is telling us how much did we give back to the stockholder and how much did we keep to retain in the company and to use for future to use to generate future revenues. And how this is broken down is and this is also a particular period of time. Statement of retained earnings is a particular period of time. So it's not it's just telling you from 1 month to 1 month or 2 months, or from one quarter another quarter or from 1 year to another year, right? So it's a particular period of time is what also a statement of retained earnings. Retained earnings beginning, right? So we take what we had at the beginning of or at the end of the last month to put into the beginning of this month, or the beginning of last year to put into the beginning of this year, and we take that net income or that retained earnings, and then we add net income or we subtract net loss for that period that we had, and then we take minus our dividends for the period, right? So we take anything that we paid out in dividends to anybody or any of the stock or to the stockholders. We also have to look at that and take it away from our statement of retained earnings. And then that gives us a retained earnings ending. This is the amount of earnings that we have generated and we are putting back into the company. Balance sheet, right? This one's a little bit different. So this provides valuable information to financial statement users about economic resources the company has. So it takes our assets, what we have in assets, as well as our debts, the company, our liabilities, and allows decision makers to determine their opinion about the financial position of the company. This is a form that just provides pretty much the accounting equation. It tells us what we have in assets, what we own, or what we have that can be used to create more revenues in the future, and then it takes our liabilities, what we owe, and then also our stockholders' equity, what we own. And it allows you to see how the company is doing as far as are we carrying up too much debt? Are we generating enough revenue? Do we have enough assets in the company to continue? Right. This is something that's very important. The one difference in this statement that we look at in the balance sheet is that it doesn't tell for a period of time. It tells for a specific date and time. So when you first generate your balance sheet, the day you'll see in the heading that it's going to give a certain date. That is what is in those accounts or what you have in assets, liabilities, and stockholders' equity at a certain period in time, not what you have for a amount of time. This is just saying on December 31st, 19 in or 2026, this is what we have in these accounts, right? From the beginning of the company to that date, that is what we have in our company, right? So it's accounting for all the time period before, but it's not giving you that time period. It's just saying this is what we have at this date. Now that could change the day after, that could change the day before, but everything to that date, that is what we had in those accounts during that till that date. Statement of cash flows. This is a good statement to recognize because this shows us how much cash the company has, and cash is needed because cash is needed to purchase things, to pay things. Unless you live off of credit, which companies can't. This is something that shows you how stable a company is. It reports on a business's cash receipts and cash payments for a period of time. This is also another period of time financial statement. It has cash flows from operating activities, cash flows from investing activities, cash flows from financing activities, right? So eh, companies do this all the time, right? They have cash flows that they've actually lent out money to companies and they are investing in other companies, right? They're also doing day to day transactions where they're generating revenue. That's cash flows, right? But they also invest in other companies as well, right? And they also may finance other companies, right? They could go ahead and finance supplies or do something like that. Think about it as a car company, right? So if you go in and you're going to buy a new Toyota, right? It doesn't matter what vehicle you buy. Say it's the new Land Cruiser, right? So you go and buy a new Land Cruiser, you go to purchase it. Well, Toyota can make money off of operating activities, right? That's selling you the car, right? Toyota can go and invest in another company, right? And they can make money from those investments. They may think that a new startup, or one of their suppliers is doing very well and they want to partner with that supplier. They may invest in that company. And then they also can make money from financing. They may finance the vehicle for you to purchase the vehicle. Well, they're going to generate cash flows from those investment activities. They're going to earn interest on whatever they sold you the vehicle for. And so their financing is also going to generate cash flows as well. So financial statements are business documents that are used to communicate information needed to make business decisions. The income statement reports the net income or net loss of business for a specific period. Like I was saying, did we make money? Did we not? Statement of retained earnings reports how the company's retained earnings balance changed from beginning to the end of the period. So how much money do we have in the company at the beginning, or how much are we saving, to how much did we have at the end where we are did we give out some? Do we need to raise more? That kind of things. Did we go and sell more stock and generate more retained earnings, right? Or did we make profit and just not issue dividends? All these things can tell us. The balance sheet reports on assets, liabilities, and stockholders' equity of the business as of a specific date, right? And now, and that's I won't go ahead and keep on beating a dead horse. We've already talked about that. Statement of cash flows reports on business cash receipts and cash payments for a specific period. Now, income statement. Let's look and see how it's broken down. The first thing you're going to see is the heading, right? So first thing is going to be on the heading is going to be the name of the company. From there is the name of the statement. This is how all statements, their headings are, this is what they consist of. The one thing that will change is the date, right? If it is for a period statement like income statement, retained earnings, or cash flows, you're going to get a heading with a date like this: month ended November 30th, 2025. Or it could also be quarter ended March 31st, 2025, or year ended December 31st, 2025. It's going to tell you the time period that these transactions occurred. Like I said, this is for us to be able to compare these statements with other dates. And then the first thing you're going to have is revenues. Now, you can have more than one way to generate revenues, right? So you could have service revenues, you could have uh, sales revenues, you can have all kinds of revenues, right? So a company could have, service revenues, they could have sales revenues, all kinds of different revenues, but we'll separate them here. And this tells us how much income the company has produced. Then we list our expenses. Now, expenses are going to be laid out and expense by expense. So in this scenario, with all the transactions we did, we had rent expense and salary expenses. You're always going to subtotal. When it comes to these statements, when a statement comes in, we're going to learn later that we have credits and debits. They do not apply to the income statement. Credit and debit, indent and going out, that does not apply to the income statement or any other statement. What it does apply to is that when we indent, we are subtotaling. So we're taking all of our totals from the interior, our subtotals from the interior, and then when we go out and we don't indent anymore, that gives us our total. So we take our subtotals of rent expense and salary expense, get our total expenses, and then we see that we generated net income. On the statement of retained earnings, we first have to, first thing is same thing with our title. We have the name of the company, the name of the statement, and then we have for the month ended November. So this is a time period statement. So this is for the month. And then we start with our retained earnings, November 1st, 2025. Since this is a brand new company, we didn't have any retained earnings. And so we start off with the zero. Net income for the month was 5,300. Where do we get that? We go back to our income statement and we carry that over to our statement of retained earnings. We see that we gave a $5,000 dividend. This is going to lower the amount of our retained earnings. And we see that we only carried over this month $300. Now, this could be a first month and it's going to be, maybe the investor needed that money, right? Maybe they put in their life savings into the company and they need to pay bills at the end of the month. That is one way that the company can give out dividends to, if there's only one stockholder, and give that stockholder a dividend, and then that stockholder would then use that dividend to pay bills or whatever they need to do. Now, statement of stockholders' equity. We can now see. We go back to, let's go cover the heading again. Name of the company, name of the statement, and then our date. And this one is also for a time period. So the first thing we need to do is take our balance of what we have in retained earnings, stockholders' equity, our common stock. And so we started with nothing at the beginning of the month, and we have zero in all transactions. Then we have issue of common stock. Well, common stock now is $30,000. Our total stockholders' equity is $30,000. And then net income for the month is $5,300. And that gives us our total stock equity 35. We don't add it, but it shows us we have a $5,300 increase. And then we minus our dividends. So what we paid out, we no longer have those retained earnings anymore. We paid them out. So we get $5,000 in decrease, and we need to decrease $5,000 dollars here. That gives us a total stockholders' equity 3,300. If we take it section by section, we see that we have $30,000 in common stock plus $300 of retained earnings, which gives us 30,300. And for the last one is the balance sheet. So we have our balance sheet. And this one is going to be a little bit different. It starts off the same. We have the name of the company. We have the name of the statement. But as this one's going to be different in that the date is going to say just the date. This is not a time period. Okay. So this is just from the beginning to this date. This is where we are. And this statement's a little bit different in that it doesn't have one single chart. It has two sections, right? On one side, we'll have assets. On the other side, we have liabilities and stockholders' equity. The reason for this is so we can generate and make sure this is a trial and error and a check and balance kind of statement. If our assets don't equal our liabilities with stockholders' equity, then we have a problem, right? We've done something wrong. And so in doing so, we need to check that these two match. They must always equal. Okay. So let's look at our assets. If we go look at our other transactions, we had $9,000 in cash. Accounts receivable is 1,000, supplies is 500, and land is $20,000. We take that, we get 30,500. Now we need to look at our liabilities. Though we had a $500, we paid it down, and so now we have $200 in accounts payable. Common stock, stockholders' equity, we can grab. So stockholders' equity, where we're going to get this information from this statement. So we go to our statement of stockholders' equity, and we see common stock is $30,000 and retained earnings is $300. Total stockholders' equity is $30,300. Total liabilities and stockholders' equity is $30,500. So we take that 30,300 plus the 200, we get 30,500. These equal, and that lets us know that our balance sheet is in order. Now, I'm sorry, I forgot. This is the last statement, right? So the statement of cash flows is pretty important because it shows us how much money we have, or as far as cash. And why is cash important? Because it gives us liquidity. It lets us, I may have nice assets, right? If I go back to my balance sheet and I can see I have supplies, I have land, I have accounts receivable, but I can't pay employees with those things. I can't pay bills or expenses with those things. I can't pay, I can't do anything with that. I can do things with cash. So cash is needed to keep the business flowing. And so let's look at the first thing we do, right? So cash flows from operating activities. First thing we're going to look at is cash flows from operating activity. We have receipts. So collections from customers, this is our revenues, right? So throughout the transactions, we collected $7,500. Now, this is total cash, right? So we don't have accounts receivable here. Just this is how much we've collected in cash only. Now, payments, what have we paid out and expenses? Not accounts payable, but what have we paid out in cash? We paid out to suppliers 2,300 and we paid to employees 1,200. So we have 3,500 down to $4,000. So cash flows from investing activities, acquisition of land. This is an investment for the company. Maybe we're going to put on more land later, or we're going to put on another business later. So this is investment activities, purchase of the land, $20,000. So now we have a negative 20,000 net cash used by investing activities. And then cash flows from financing activities. So financing activities is going to include common stock, $30,000, payment of cash dividends, $5,000. So we have 30,000 minus the dividends, 5,000 gives us $25,000. So we take our 7,500 plus we got down to 4,000. We're going to take away 20,000 plus the 25,000, which gives us a net increase in cash of $9,000. Now, at the beginning of this, we didn't have any cash, right? If we would have had, if this is a statement of cash flows and say this is December statement, we would start off with this 9,000. But since we had nothing to start off with the beginning, we have $0. At the end of the month, we now have 9,000. So this tells us at the end of November, we have $9,000 to pay employees to keep the business flowing, to keep on doing things. And so this tells us how much cash we have on hand, which is important if we have big bills coming or you have a big expense or something like that. You need to have cash to pay that. Now, let's talk about Objective 1.6, using financial statements and return on assets to evaluate business performance. So here's the thing. Now we can use some of these equations, which I do in my finance class. We use these equations to analyze how a business is doing. And this tells us, return on assets. And let's talk about this. Return on assets, right? So how do we use financial statements to evaluate business performance? How can we look at our financials and go, is this business doing well? Or is it doing bad? Or, where is it in between? So one of the many tools used to evaluate performance is return on assets. What is return on assets? Return on assets measures how profitability a company uses its assets. What it's pretty much saying is we have this much that we've paid into these assets or that are supposed to generate revenues and more income for the future. How much income, how much are we spending on these assets? How much are they worth? And then how much income or revenue are they generating? So we have our RRA is calculated by dividing net income by average total assets. So return on assets is net income, average total assets. So how do we start with average total assets? Average total assets, we take the beginning of total assets plus the ending of total assets divided by 2. So if we take, at the end of 1 month, we take our beginning of total assets and we had, $10,000 in assets. And at the end of that month, we had, the next, we look at the next balance sheet and we go, we had this much in total assets divided by 2. That tells us what our average total assets are. Let's look at this scenario, and I don't want to say what's good and what's bad because we're going to talk about what that is in the end. On its 2021 income statement, PepsiCo reported in 618 million, which is, I want to say what that billion, 7 billion. The corporation reported beginning total assets found on balance sheet of 92,918 million and ended in total assets of 92,377 million. So that's in the billions, right? PepsiCo's return on assets for 2020 is all the amounts in millions. So this is, if we were to do this in Pearson, which you may have a problem like this, just be careful. I will say this as you're doing problems in Pearson. The one knock on Pearson I keep on requesting is they do not show commas. So make sure you're keeping your spacing. You know how many zeros and how many digits you're importing. Because sometimes if you look at this number, 92,007, it's easy to add an extra 7 and not notice it if there's no commas. Okay, so just make sure you pay attention to things like that when you're doing your homework. So return on assets, we have 7,618 million divided by, so we take our first balance, 92,918 plus 92,077 divided by 2. That gives us 92,648 rounded. That's what that asterisk is. And we're going to take 7,618 divided by 92,648, which gives us 0.082. If we take that in a percentage, always to know how much a percentage is, you'll take move the decimal place over 1, and then that's where you'll have 8.2%, right? Or you can times it by 10, and that'll give you your percentage. So if you have 8.2, you can always divide by 10, and it'll give you your percentage as well. And it'll give you that 8.2. So 8.2, right? So is that good? Is that bad? Well, that seems pretty good. What is that saying? It's saying that for every dollar that we have an asset, we are generating 8.2 cents in profit, right? So for everything that we do, all our assets are almost 10 cents for every dollar that we have in assets. We're almost making 10 cents in profit for every dollar that we have in assets. Now, here's the thing, and I don't know if they go into this. If I want to look at a stock, and you can say, well, is that good? Is that bad? How can I use this information? The way you can use this information, and I'll tell you right now, look at the ROAs, is that you have to have something comparable. And it has to be a business that's very similar to this one. If you read your book, you'll notice that it doesn't end here. It goes on and talks about how this 8.2% may be amazing compared to a car company, compared to an aviation company, right? That may be great for that amount, right? But it may not stand up to Coke, which is also a beverage company, right? And Pepsi's biggest rival. So if Coke is at making 9.9% or 12% in return on assets, Coke looks like it's a better investment, right? So the way you use this information is you take this and then you compare it to a competitor or a very similar company and then decide who's doing better, who's making more with what they have, who's generating more profits with the amount of assets that they own, right? So what it's pretty much saying is if this company gets more assets, they're going to generate more profit and they're going to generate about, 8 cents on a dollar. If another company can generate 10 cents on a dollar, then you're going to go with the other company because they're giving you more of a payback or of a return on what you're putting into this as the assets, right? When you contribute to the company, if you are first purchasing, we don't have to get into, but what you're looking at is this company is doing better with what they have. They could be taking the same amount of money and generating more profits because they're getting a better return on the way they are using their assets. So that's how you can use this equation for investing. I hope I didn't confuse you too much. I hope this was informative to you. I'm also going to have this made into a podcast to help you. And so if you like the video, let me know. If you don't, let me know if you like the podcast. I hope this helps. If you have any questions, I'm always available through email or to call me, and I will return your phone call, and I'll be happy to answer any questions you may have.